Welcome to today's deep dive. When you think of Bitcoin, you usually think of a wild, untamed river, like all chaotic rapids and unpredictable volatility.
Yeah, thrilling for day traders, sure, but I mean, absolutely terrifying for corporate accountants.
Right, exactly. But looking at the market data for July 15th, 2026, it looks like that wild river is being dammed up, like they're building this massive, predictable reservoir.
Highly managed one, yeah.
So our mission today is to analyze this huge structural shift going on right now, the transition from retail volatility to long-term institutional accumulation. Okay, let's unpack this.
Well, we need to start with the macroeconomic picture because it really sets the stage. We just saw wholesale inflation drop in June, with the producer price index falling 0.3%.
Wow, okay.
Yeah, heavily led by the energy sector, dropping 6.4% actually.
Right, and the market reacted immediately to that. Bitcoin rallied about 3.05% over 24/7 trading, closing near $64,687.
A really solid jump.
It is, and when wholesale inflation drops like that, it's basically like taking the ankle weights off the Federal Reserve. They don't have to keep interest rates sky high, which makes it cheaper for investors to borrow and, pour money into markets.
Exactly. And the reason that matters for digital assets specifically is that lower inflation expectations structurally encourage capital to flow outward, basically into assets with a fixed supply.
And because that macro environment just flashed a green light, we're seeing incredible movement. It's driving over $181.1 million in daily ETF inflows, and it is not retail traders anymore.
No, definitely not.
We're talking massive registered investment advisors like RIAs, firms like Cap Trust with over 1.08 trillion in assets, and LPL Financial. So the financial advisor managing your parents' retirement fund is likely baking Bitcoin into their standard portfolio right now. But let me push back here for a second.
Sure, go ahead.
Are these institutions real believers, or are they just running a basis trade?
Yeah.
Exploiting tiny price gaps between spot and futures markets for a quick, risk-free profit.
What's fascinating here is that the data actually points away from those short-term cash and carry trades. It's moving toward unhedged, long-term wealth diversification.
Oh, wow. Really?
Yeah. Just look at algorithmic corporate treasuries. SRX Global just published their EMJX crypto treasury model. And they use these complex overlays like options and dynamic rebalancing across different market states.
Oh, to smooth out the cycle volatility.
Exactly. And by actively managing it, they beat static Bitcoin returns by 29 percentage points.
That is massive. So this huge capital is flooding into this new institutional reservoir. But because of all that volume, traditional banking is suddenly becoming a severe bottleneck.
It really is.
If you look at the MicroStrategy Banking Adoption Index, there's a crazy divide. Tier 1 institutions like Fidelity are fully integrated. But Tier 2, the big U.S. bulge bracket banks, are stuck around 43 to 46% adoption. They seem incredibly hesitant.
This raises an important question about regulatory friction. Capital risk weightings currently make it really punitive for commercial banks to hold digital assets.
Because of the reserve requirements.
Yeah, basically regulators force banks to hold massive amounts of cash in reserve for every single dollar of crypto they custody on their balance sheets, which makes it totally unprofitable.
Right, that makes total sense.
But the upcoming July 17 Clarity Act hearing is aiming to classify digital commodities versus securities. That could act as a safe harbor, removing that penalty, so Tier 2 banks can finally expand their custody without taking a hit.
Now, because all this institutional money is flying to the safety of Bitcoin, it's actually sucking the oxygen out of the rest of the crypto ecosystem. Here's where it gets really interesting.
Okay.
Canaan, the mining company, just reported their metrics. Alongside their Bitcoin, they are holding 3,952 Ethereum. Why would a pure Bitcoin miner hold ETH?
Well, it's a calculated hedge. Ethereum offers staking yields, and its price action can decouple from Bitcoin's specific mining difficulty cycles.
Ah, so they're using it to protect the revenue margins.
It's exactly. To hedge localized revenue volatility. And that defensive posture mirrors a broader altcoin liquidity drain we're seeing. Just look at the ZKP token. It crashed 5.84%, just ahead of a token unlock of less than 0.7% of its supply.
Wait. A tiny fraction of a percent unlock crashed the price almost 6%.
Yeah, it's wild, right?
That implies there is absolutely zero liquidity in that altcoin market to absorb even a drop of new supply.
Precisely. In this hypersensitive environment, buyers flee from any equity dilution. All that residual liquidity just gets funneled straight back to the safety of Bitcoin.
So what does this all mean? It means Bitcoin is maturing. It is transitioning into a highly managed corporate treasury staple.
If we connect this to the bigger picture, The entire nature of the asset is fundamentally changing from a speculative tool to a systemic anchor.
Which leaves us with a pretty heavy thought for you to end on. If mega banks, trillion-dollar RIAs, and algorithmic corporate models dominate this market to smooth out the volatility, does Bitcoin eventually lose the decentralized independence that made it so valuable to you in the first place? I mean, has the wild river been tamed a little too much?